we now invite three very special guests into the show. We have with us the big three who dwell about India, who concentrate on India and take calls on India from UBS. Gautam Chhaochharia, the head India research, of course we meet him often. Geoffrey Dennis, head global emerging market strategy, and we meet Geoffrey as well a goodish bit. As well we have with us Edward Teather, India and ASEAN economist at UBS. They are joining us from the sidelines of the 10th annual UBS India conference. Gentlemen, thank you very much for joining us. It's a pleasure to have probably the brains trust of UBS with us this morning, despite what must be a very busy schedule for you. Well, let me start with you, Edward, actually, because there is a Reserve Bank credit policy and you very closely watch the Indian scene. What is your sense, one, on what the Reserve Bank will do on December 2nd? But more importantly, do you think the back of inflation has been broken in India?
Well, thank you very much for the opportunity to speak, and very happy to be here in India at the 10th UBS conference. Looking at the RBI, we don't think the RBI will ease policy on the 2nd of December, but we do think easing is around the corner. We've penciled in a 25 basis point cut in the March quarter. We do think that inflation is going to come down on a sustained basis. Obviously, we've had some pretty low prints in the recent past, but we think the average rate of inflation through 2015 calendar and 2016 calendar is going to be a good bit lower than it has been in the last 5 years. So we think the economic conditions in India and government policy and RBI policy are in the process of breaking the back of inflation.
So what would you pencil in? Next year, if we met at the same time, will rates be 100 basis points lower, 50 basis points lower? When will they cut first, you think?
Well, I'll say we do think they'll cut in the March quarter, 25 basis points, and then 25 to 50 basis points in the following few months. So this time next year, we would be thinking rates will be, RBI rates would be 75 basis points lower. The RBI, we think, isn't going to rush into a major cutting cycle, but market rates may move a good deal lower than RBI rates over the next 18 months or so.
That's interesting. Geoffrey, hi, morning. What's the next big trigger for Indian market from here on? It's been a big outperforming market, up 33% even in dollar terms. One of the best performing emerging markets. Do you expect this kind of outperformance to continue? And what would potentially lead this market higher from here on?
I mean, from my point of view, relative to emerging markets overall, I just think it's one of the best stories there is out there in terms of the reform agenda, the potential for the economy to pick up, the really excellent performance by the corporate sector compared to what you're seeing in a number of other emerging markets. So although the market's done well and a lot of people are invested already in India, we would be very surprised if you don't continue to get outperformance on trend. I mean, obviously you'll get pauses, you'll get profit taking by foreign investors at various times, but we think it's a great market and we would expect it to continue to outperform. And bear in mind, that's in a world where there really are some relatively poor stories in emerging markets, and where growth is a real challenge and corporate earnings growth is particularly a challenge. So India just doing what it's doing with the reform agenda and with the pickup in growth and the good corporate sector performances is really a standout, and I would expect to see that to continue to lead to outperformance within the emerging market asset class.
Okay, so Geoffrey,
one more word on what happened over the last 24 hours, Geoffrey. The change in Japan, it looks like a second wave of Abenomics, if you please. Elections called, more fiscal stimulus, and disliked sales tax being pushed back, and all this on the back of some 80 trillion yen that the BOJ will print. In the first wave of Abenomics, some money got attracted away from other emerging markets. Could that happen at all?
That's a very big question. I think what you assume from the events in Japan over the last 24 hours, it does inject another element of uncertainty into the situation. One would presume that the election will lead to the re-election of of the ruling party and for Mr. Abe to continue to be Prime Minister. But obviously that creates some uncertainty. I think the elimination of the next stage of the consumption tax has got to be good for the economy. But overall, it does inject some uncertainty. We as a House have the view the dollar is going higher over time, albeit perhaps not as rapidly from here on as it's done recently. And of course, that does tend to suck money out of the emerging markets. I don't think emerging market money is going to go to Japan per se, but a stronger dollar tends to suck money out of the emerging markets. And therefore, we need to really see whether this is going to be a weak yen move, which doesn't have to be that bad for EM, or whether this is going to be a broad-based dollar move, which would pull liquidity out. So I think what this has done in the last 24 hours, frankly, is injected a bit of uncertainty into that. And I think we have to see how these events play out politically in Japan. And, of course, we need to see how events play out with monetary policy in the United States, which will be such an important driver of liquidity flows in 2015.
Okay, before I go to Gautam, Geoffrey, just one more word. Do you think there's a risk of India getting overowned in the emerging market funds with the kind of outperformance we've already seen and with the kind of outlook that we have for Indian market? Is there a risk of an over-ownership and, making India a bit vulnerable in case, the strong action does not come from the government front?
I mean, I think it is overowned now, frankly. We've met some investors who are very highly weighted in India compared to the benchmark. But I also think that some investors have been reluctant to buy in recently because the valuations have been so high. And as I say, without repeating myself too much, I mean, this is a great story, and I think there will be more money to come. So in the event of a piece of negative news on the domestic front, yes, of course, you could see some heavy profit-taking. But I think it's an overweight that's going to stay an overweight, and it's probably going to bring more money into the market. So I think we should focus on that because this is a really good story by global emerging market standards.
To continue with the theme, Gautam, will a no rate cut on December 2nd create that profit-taking opportunity at all, or will the market take it in stride?
Good morning. I would argue that the markets will take it in stride. The other part which we've been arguing in line with our inflation thesis is RBI policy will act with a lag. So what's more important for corporate earnings, for market sentiment, is how the actual interest rates in the market, the short-term interest rates, the 10-year yields react. And if you have not noticed that over the last 3 to 4 months, 10-year yields are already down 40 basis points. Short-term rates are off. You're already seeing banks cutting rates selectively. So that's a far more relevant point as far as corporate earnings and the overall macro environment is there. So RBI action will act as a sentiment catalyst, but I would still expect them to act with a lag, given for them the focus is on inflation expectation moderation, unlike, say, other central banks globally.
Okay. Your colleague Edward is talking about a 75 basis cut from the Reserve Bank, and market yields will be much more, market yield falls will be much more. So if that's a 150, 200 basis point fall in 10-year yields, Gautam, how does that influence your stock choice?
So massively overweight financials. So that has been a key overweight call for us. That remains so. And even in our macro thesis of a more gradual and mild growth recovery versus some of the more exuberant street expectations, banks will still do well because of rates coming down, because it impacts not just their bond books, but also lowers credit costs sharply. And credit cost is a big issue for financials right now in India. And just one rudimentary analysis we ran, 100 basis point lower interest rates means 20% lower stressed assets. So that's going to be big for banks.
Indeed, that's a big call from UBS, still overweight on financials. But Edward, one of the big points this year for Indian market has been the currency, because for last 2 years there was a big currency risk for foreign investors. This year, the currency has been stable in face of very strong dollar. Do you expect that to continue, the rupee's resilience, or would you expect some kind of weakness now from here on?
Well, you've already heard from Geoff that we do expect a stronger US dollar going forwards, perhaps not quite as strong in terms of pace as we've seen in the recent past. My bias would be to expect a modest decline in the rupee just against that strong dollar. But on a trade-weighted basis, the rupee is in a good position to hold up relatively well. One of the things we expect the RBI to do is its rate reductions lag those of or lag somewhat the fall in inflation, is that real rates will be a bit higher, and that should keep the currency well supported against the US dollar.
Okay. Well, time permitting, I'll come back to that. The Reserve Bank has been trying very hard to actually keep the rupee weaker than where the market is keeping it. But Geoffrey, Dennis, what's the global situation of fund flows looking like? What asset classes may be preferred in 2015?
I think that the line that we're taking, certainly from an asset allocation point of view, is that equities are preferable to bonds. We have quite a negative view on US bonds, although obviously yields are low right now, and they've been in a fairly quiet trading range for a while now. But we think equities will outperform bonds in 2015. We suspect that within equities, emerging markets may not outperform. We're particularly bullish as a house on European equities following the sharp decline in the euro recently. But we think it's quite interesting that we think the technical position for emerging market equities is quite good. We believe that global investors are still very underweight emerging markets, perhaps not as underweight as they were at the start of the year when, of course, we had a big kind of mini meltdown, if you like, in EM at the start of the year. But we feel they're still relatively underweight. You've seen 3.5 years of underperformance by EM equities. Also, we've been intrigued by the fact that the outflows that you had from EM funds earlier in the year have largely been recouped. We've seen, compared to the middle of March, around $28–29 billion of money coming back into EM funds. So that money is available to invest. So we think the technical funds flow position is quite good for EM equities. It's just that we suspect that other parts of the equity universe as well will also do fairly well next year, in particular Europe. But yeah, I think the funds flows look actually pretty good for emerging markets, frankly.
Okay, so let's talk about some stocks and sectors then. Geoffrey, from your portfolio, I find it quite interesting that you are quite overweight on energy sector in India, and you have the two large players there, ONGC and Reliance. What makes you so bullish on this particular space?
First of all, to be fair, we need to make some adjustments to our portfolio following the upgrade that we made to India within our Asian portfolio recently, so I wouldn't focus too heavily on that. We made a call on energy earlier in the year, which worked quite well for a while. I don't mean energy in India, I mean energy just generally. And lastly, of course, with oil prices falling sharply, that's been a poor call. So actually, from a GEMS point of view, we downgraded energy to neutral about a month ago, and we think that's probably where investors should be. It's a sector which is very cheap by emerging market standards, by far the cheapest sector across the emerging universe. But of course, the falling oil price has been a negative for the sector. So we really don't particularly focus that heavily on energy right now. And our other overweights are within EM by sector are financials, industrials, and IT. And certainly, particularly on the financial side, reflects very much what Gautam is saying as far as India is concerned. So our big call right now is to be overweight financials within EM overall, and that ties in very nicely with India.
Okay. Well, a change or a steep fall in commodity prices, especially oil prices, changes India's macros, its micros, and its markets. That question to you three gentlemen,